On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hey team, hope you're all well. Nearly Christmas Day, so maybe put this on while you're walking around the shopping mall getting those last minute presents. That is probably what I am doing right this very minute. But anyway, I thought I would recap another episode that got a lot of attention, and to be honest, it's one that I get asked about all the time, non-stop. Should I pay off the mortgage faster, or should I invest that spare money I've got so I could pretty much roll this out every 6 months and it would still be useful to somebody? Especially relevant today because while mortgage rates have come way down from the highs that we saw a couple of years ago, borrowing costs are still above the average of the past 15 years. You know, they're higher than that COVID period and they're higher than that period that we saw just before COVID, 2019. So it's an important question. And right off the bat, I'm going to say that the question is only relevant if you're a pretty good saver, if you are quite disciplined, because if you're not disciplined, if you're a bad saver, if you're not so good with a budget and you're inclined to spend any spare money that you get rather than investing it anyway, then you should probably pay off your debt as quickly as possible. For you, if you've got that tendency to give in to temptation, then paying off the mortgage is like a forced saving scheme, and it's probably exactly what you need. So for people that struggle with saving, struggle with budgeting, then make those mortgage payments as high as you can live with and just force yourself to pay it off, because then you'll smash it down as quickly as possible. Now, for others who are pretty good at making those decisions, sticking to the budget, and they will genuinely invest some of that spare money if they don't pay it off on the mortgage, then it's not completely black and white, and you just need to think about what's right for you. I'm not going to give you a definitive answer. Paying down the mortgage as quickly as possible is always sensible, and it will set you on the path to financial freedom. And it will also allow you to borrow it back later, and that's another story again. But if you do invest in something that is generating income, an investment property, a business, a share portfolio, that interest then becomes a tax-deductible expense, unlike the mortgage on your family home. So this can be a really tax-effective way of structuring your borrowings, because in the eyes of the IRD, it is all about intention. What did you borrow that money for? If you bought it for your own home to live in, not tax deductible. If you bought it for an investment, that generates income and therefore you pay tax on it, tax deductible. So that's the difference. But anyway, we're going back a couple of steps and back to that decision of pay down the mortgage or invest your spare money. Investing some of your spare money can make sense along the way. So right now, the best 1-year fixed mortgage rate is about 4.5%, isn't it? So if you're going to make additional payments on your mortgage right now, that's essentially the return that you're getting on that money. 4.5%, because that's what you're saving yourself from having to pay on the mortgage. So you want to compare that 4.5% return for what you will get by putting that cash to work elsewhere. Now, start with term deposits. They are a very low risk option, and at the moment the 1-year advertised rate is about 3.5%, right? Before tax, that is. So apart from your liquidity buffer or your emergency fund, there's no point leaving that excess money on deposit at 3.5% if you've got a mortgage that is costing you 4.5%. Because remember, you've got to pay that mortgage out of your after-tax income, right? So if you've got a $100,000 mortgage and 4.5%, that's $4,500 a year. you've actually got to earn 6,000 or 6,500 so that you've got the 4.5 after tax, don't you? So think about that as well, after tax income versus pre-tax income. Right, other options beyond the term deposit, which is the low risk option at 3.5%. You've got managed funds, you've got shares, you've got investment property. All of those things should give you much better returns than that 3.5% term deposit. However, they will come with a higher risk profile, which means more volatility and more ups and downs. Now, looking at shares over the past 30 years as a guide, annual returns have been somewhere in that 8 to 10% range per annum. Okay, house prices, it's been high fives, close to 6%. Let's just call it 6% over that same period. Now, those gains are above the average cost of borrowing currently. 4.5% mortgage, 8 to 10 from shares, let's call it 6% from property. And that's higher than where mortgage rates have been for most of the last 10 years, right? So on that basis, you would say I should invest that spare money rather than paying off the mortgage because of that premium that I'm getting from that return from those higher risk assets. However, you've just got to remember that the gains don't come consistently, do they? It's not a straight line. So the share market has had plenty of ups and downs along those 30 years. We've seen 4 declines of more than 25%, lots of smaller ones too. House prices, they've been in an extended slump for the last 4 or 5 years, and they're still about 15% below where they got to in 2021. So over time, markets will recover. House prices, share markets, they'll recover. And in hindsight, we look back on those periods of difficulty or volatility, the downtimes, and we look back on them fondly because that gave us opportunities that we could take advantage of. However, those rough patches, they're pretty scary when we're in the thick of them. And contrast that with the return, and I'm saying return in inverted commas here, the return you get from paying down the mortgage, that is absolutely 100% free of risk, volatility, and certainty. If your 1-year fixed mortgage rate is 4.5%, then the return, in the sense that the interest you'll save and won't have to pay, that return is not at the mercy of the economy, politicians, Trump or whatever's happening in Wellington next year for our election, policymakers at the Federal Reserve, the Reserve Bank of New Zealand, market sentiment towards where prices for some tech stocks and AI stocks are at. None of that matters because your return is 100% rock solid and it's guaranteed. So that is the difference. And that is why a textbook, an Excel spreadsheet, or your very purist, safe and steady accountant friend, they are all quite likely to say paying down the mortgage makes sense because there is nowhere in the investment world where you will get a similar return, 4.5% for zero risk. You never find something that is risk-free. But it's not that simple, and that's not necessarily always the right approach. So that's why I said right back at the start, I'm not going to give you a definitive answer, and that's not a cop-out. That's just because the right approach is different for all of us. Doing some investing on the side can be a really good choice for many people because maybe you'll catch a wave of great returns. If you had chosen not to pay off the mortgage over the last 2 or 3 years and instead invest that money in US shares, you'd be very happy about that, wouldn't you? You have made much, much, much more than you would have ever saved in interest. Might not always be the case, but it has been the last few years. Even if you don't make money, you are still going to benefit from the knowledge that you've gained by educating yourself about markets, about money, about how shares and investments work, and that could prove really invaluable in the future. What tends to happen is that when people have skin in the game, they tend to pay much more attention to something, right? So if you've got a few investment interests, even if they're modest ones, that might give you the motivation to follow the economy, read the business pages, listen to what Mark List is saying on his podcast, and learn how financial markets work. And while you're unlikely to find a better risk and return proposition than making additional mortgage payments for that risk-free 4.5% or whatever it is by the time you listen to this, you'll learn a lot and you'll put yourself in really good stead to make better decisions in the future. So just have a think about that. No right answer, but we all need to just consider what is right for us. All right, team. Merry Christmas. Thanks for listening. We'll talk again soon.
For more insights, visit craigsip.com.